Hi there, and welcome to our May edition of OnTrack. I'm actually recording this on June the 19th. I'm in Sydney, seeing some of my wonderful clients down here in Sydney, back in Noosa in a couple of days. And as always, another interesting month. Let's get into it. So, firstly, a general advice warning. These videos, which we do monthly, are prepared for clients of McGregor Wealth Management. They're general and advice only. For my clients, we talk about this stuff in your regular review meetings and we adjust accordingly. For anyone who's not a client of McGregor Wealth Management, make sure you seek advice before acting on anything you see here. So what we're going to cover, as always, is we're going to have a look at the latest important market news, put that into context for what it means for you and your long-term investment and planning strategy, go through some updates on key markets, and put it all in perspective. So let's get into the news. And another fascinating month. Post the election result, we had a real rally in the Australian stock market. We were one of the only stock markets to go up during May, and it was purely relief on the Australian part. We saw banking stocks recover. The market was worried about the impact of a Labor government on the banking stocks, so there was a bit of relief in that. Also, investors with franking credits who are very much overweight banking stocks across, as a generalisation, relief there. Iron ore prices went up as well, so the big miners, BHP and Rio, up. And when the banks and BHP and Rio Tinto go up in Australia, that means the ASX 200 and All Ordinaries go up because they do dominate a fair bit. Now, we saw the RBA cut rates by 0.25%, and they've indicated, and they've continued to indicate since, even in today's financial review, talking more about that rates are likely to be cut further. So they're seeing a weak economy and they're trying to help stimulate it by cutting rates, and it remains to be seen whether that works or not. A really significant one for the Aussie market, and this helped the banks rally as well, was APRA removed a limitation they've had for the last couple of years, where they insisted the banks still qualify loan applicants for home and investor lending using a 7% rate. Now, when lending rates are closer to 4, some as low as 3.5, investment rates up to sort of 4.5, 7% created a much bigger hurdle that meant a lot more people didn't qualify. So they've removed this requirement. That's going to mean the banks can assess at a reasonable rate, closer to 4 or 5 or 6, which will mean more people will qualify for lending, which once again should be good for boosting economic activity. On economic activity, we saw the first quarter GDP results out. They were very weak. Annualized, they show growth of GDP at about 1.8%. That's about 1% below the trend given current inflation requirements. So it's not a great thing, and that's why we're seeing cuts by the RBA and talk of infrastructure spending needed. On the international front, we've got the continued trade war between China and the US. Trump did bring Mexico into it, and you'll see when I go through the market performances. This caused markets to drop, thinking, well, this guy's going to go extreme on the trade war and he's going to bring anyone into it. He did eventually, after the end of the month, make peace with Mexico. Hard to always understand all the details on these things about what actually happened, but that caused the market to rally strongly after the end of the month. Trump announced he was not ready to make a deal with China, and the US, and China immediately countered with the US shouldn't underestimate China's capacity to retaliate. So they're in a standoff at the moment. We've got the G20 meeting, which is the top 20 economies of the world, coming up. It's highly likely Trump will be talking to China, and we still think he's likely to want to get a solution before the election campaign starts in the US, and it is an election year next year. Rates are likely to stay lower for longer. No change in that. The big impact is if we do have a prolonged trade war is we've got slightly slower growth. Analysts differ in their arguments, but let's call it somewhere about 0.5%, give or take a little bit. So while that cuts growth, we're still talking about growth, and a world economy that's growing, even at a slow rate, still provides room for companies, which you invest in, to continue to keep their market share and increase their market share. And the other news, it's a bit old now, but Theresa May resigned. That's now taken effect, so she just couldn't get Brexit through. Brexit's not something I'm particularly worried about in terms of global sort of share markets. It's a hot topic if you're English or European, as it affects the day-to-day mechanics of trade. I don't think it's going to have a major impact on world growth, which ultimately affects our markets. But I'll put some of this into context while I'm talking about different markets, and just to provide that the base methodology around a market context. We talk about the three stages of the market: the boom, the bust, the wall of worry, and our attempt to categorize where we're at any one point in time. There's never a perfect never a perfect method of doing that, but we do put a lot of time and effort into doing that, and it does help our clients, you guys, put all of these things into context. Those long-term charts always there to show that the normal is up, with occasional small dips and very, very occasional big dips. And I don't think we're close to any big dips at the moment, but let's get into talking about, before I get into the markets, I just want to remind, and some of you may have seen this before, we actually produce about a 41-minute video for new clients, which we've had for about the last 18 months, on our investment philosophy. And this is one sort of slide from that I just want to dig into. For anyone that wants the link to that video, who's been a client for a long time, longer than last year at least, just reply by return, yes please, I'd like the link to that, and we'll send you the link to that. We also have one on our property methodology as well, so we could send you those links if you're interested at any stage. But we talk about how most investors mess it up, and if you see the top right hand chart there, we know that most investors, signified by the red bars, get way less return than the green bars, which is the return that the investments get. So this comes from the Dalbar research, which has been going on for 30 years, and many of you will have heard me talk about this, that shows that the long-term returns that investors get, which is the red bars, are very different from the returns that investments get, which is the green bars. Now that's because they mess it up. They do silly stuff at the wrong time. They panic when the market's down, they get excited when it's up, they switch between investments, looking for performance in the rear vision mirror, and all these things. And the mess it up analogy just is the initials that stand for some of these reasons how they mess it up. Now I'm just going to focus on three today because it's very, very relevant. Whenever I go through the news, you'll notice the media always creates a bigger negative picture than things actually are. That's because they've got to keep you paying attention, and they love single issues. So the trade war is now quite clearly a single issue, and we get obsessed by a single issue, and they never matter in the long run. We've had millions of single issues, from bird flu, SARS, we got all the health related ones, to Asian crisis, Russian crisis, and so many other economic single issues that seem big at the time. We've got things like Y2K, and history's full of them. And when you look back, they made very little difference to long-term investor returns, but they did provide a massive distraction, and it causes us to focus too much on the short term. And while I bring all this news to you on a monthly basis, I don't want that to make your focus short term. And the only exception to that is if you've got money on the move, and that is if you're about to invest a significant sum of money, or you're about to withdraw a significant sum of money, then we always want to be cognizant of the market. But once we're in, we know that we quite clearly get the best results by staying in and tweaking around the margin, which I'll go through some of those strategies as always today. So let's have a look at what the market did, and this is results to the end of May. Some of the charts go beyond that. So Aussie shares, we had a positive month, 1.74%, and you'll see in a minute when I get on to the other markets, we were the only positive share market out of the ones that we follow. Now, and that was even, you can see the little box there that shows the ASX 200 was 6,396 at the end of May, which is about where that little dot is. So you can see we dipped a bit further, and then we've had a massive rebound since. So even these numbers, as always, are out of date. So the first half of June has been very good, which has pushed all these numbers up. And you can see how steady the long-term historical performance is at the moment, right about that inflation plus 7%. Inflation plus 6% range that shares have done for 100 years. The bottom right hand chart, the green line, is the Aussie market back since before the crash, and I put that in because it's interesting. We're fast approaching that level again. So the peak was somewhere around 6,700. We're now bouncing around 6,500. That's the ASX 200. So it's highly likely at some stage we may break through that previous peak. As we've always expected, the Australian share market, along with other world share markets, have always gone back past their previous highs, always without exception. This will have been a long time. The previous high is now nearly 12 years ago. So this will be 12 years. This will actually be the longest in Australia's history that it's taken to get past, but that's quite appropriate given it was one of the biggest downturns. So when we look at these 10-year returns, to put them into context, they're from lows seen after this high. So they're not areas that we're worried about. So we actually have the market assessment at the moment at fair. At current levels at about 6.5, it's slightly expensive, but nothing to cause any concerns or consequence. And the only time we take that into account is where people have money on the move, but no reason to change anything. So we're in that fair to slightly expensive range as at the time I'm recording this. US share market, a negative month, so down nearly 5% for the month. That was purely off the back of trade wars. To put that into context, you can see that 5% down is much smaller than the 20% they went down in the lead up to Christmas, which was also off the back of trade wars. So the market's getting used to it. They're starting to say, well, it's probably not going to be as bad as we first thought. And as soon as Trump solved the problem with, sort of fixed up his own problem with the Mexicans, it bounced back up. And that was the main reason for that rebound back up, along with other economic news. So you can see the rebound there. It is important to note, US shares in the last 12 months have been fairly flat in their own country, but because the Aussie dollar's dropped, you can see there that for us nearly 10%, and that's that light blue line, is the result of the Aussie dollar. And one of the reasons we diversify into overseas shares is because we do get that benefit. So US shares up about 12% for the year, but 10% of that is the Aussie dollar. And I found this cool chart when I was looking for something long-term on the S&P 500, which is the US share market, which shows back from pre the Great Depression, with plenty of volatility, the US share market is up well over 10 times pre that, plus dividends, because these charts don't include dividends. So we're in a long run at the moment, but it's a fairly steady run. And you'll note before major crashes in the US, they do have quite steep increases rather than the steady wall of worry. So we actually think US market's been sideways for 12 months. That leaves it at about fair value. If it runs much harder, it'll be slightly expensive, but once again, nothing to be concerned about. US small caps down 7% for the month, so a big down. It's always a more volatile. Its long-term returns are still looking strong. For the year, it's down 2%. This has brought this fairly back into the fair range, and we did exit this sector back last year when it got quite lofty, and we returned back in earlier this year. And very happy to be in this sector, which does produce long-term returns greater than large cap shares over the long run. You can see those long-term historical returns closer to 13 compared to closer to 10 for large cap shares. We hold this in smaller amounts than our large cap shares, depending on your portfolios, purely because of the risk reward and the management of a good asset allocation. So global leaders, so this is IOO, this is the top 100 companies in the world, which you hold in your active portfolios. Also down nearly 5% for the month, but in the top right hand corner there you'll see a strong recovery, which means it's actually at a high. So if assuming the numbers stay the same through June will be a very positive month, which will outweigh that. Very solid over 1 year and all the way back through 10 years. We think that's fair value. Slightly, and keep in mind the fair value is at the end of May, so it's getting slightly to the expensive stage, but not to any worrying levels whatsoever. Emerging markets, the biggest impact of the trade war, down about 6%, recovered a little bit since. But once again, emerging markets do perform extremely well long term. The emerging world grows quicker than the developed world. Developed world growth is stuck sub 3% and sub 2% for someone like Australia at the moment, and sub 1% for Europe. It's the developing world, China, Vietnam, Brazil, and others that are growing stronger than that, which bring world growth up to more like 4 to 5%. So these areas will prosper, but the market is worried about the trade wars. These things, as always, will be worked out. So we rate that as cheap to fair, and very happy to hold that for long-term investors. Once again, in smaller quantities than your Aussie shares or your US shares. What's that meant for performance for the month to the end of May? So I've added something this month. So I'll just explain the two differences. So the core funds are the top ones. So if you're a balanced investor, you'll be in the core balance fund as your core fund. You have the other elements of the care portfolios for most people. So in the bottom half there, the care things we're referring to there are where we add the A and the E, the active funds, and then the E with the Aussie shares and the international shares. So returns generally slightly higher in that segment. Now I've put on the right here a long-term target. So for someone who's in a balanced portfolio, a target there is about inflation plus 4% over time, for growth about inflation plus 5%. So the numbers that are being hit are consistently above that at the moment. If you put inflation at the moment about 2%, and the RBA average that they're targeting is 2.5%, they haven't been able to hit that in the last 5 years, so inflation's been closer to 2 to 2.5. So if you add 2% onto my targets, you'll see that the actual returns that we're seeing, particularly over 5 years, but also over 3 and also over 1, are quite consistent. 1 month returns a little bit negative in anything that had shares in it because of those international share drops, but once again, that's already old news. All those things have now fully recovered and on their way up again. As is the normal, it's the downs that are temporary, the ups are permanent. So that's performance continuing to be good. The funds consistently have been in the top 10 to 20% of comparative funds and above their benchmarks, which is something we're very happy about. And those are after fees as well. Home prices, we've got continued red ink up there, which means although it's potentially slowing post-election, for the month you'll see small drops. Now these aren't prices, these are the index that they run in all the states, but it is up-to-date data to the end of May. So we've seen small percentage drops in all the capital cities in the month of May. And for the year to date, large in Sydney, Melbourne, small in everywhere else except for Perth. And I'll show you what sort of Herron Todd think those markets are at. Many experts, gurus, are calling roughly the bottom of the market, which when you look at what APRA's done with that loan qualification rate and buyers coming back with increased certainty post-election, we're seeing a return of buyers. There's often a period of uncertainty before election, which we absolutely saw this time. Who knows whether we've actually hit the bottom, but we're probably fairly close to it. Herron Todd White have updated some of their statuses, and this is the property clock, where they show where various regions are. And keep in mind, within each region, there's lots of sub-regions and lots of sub-markets as well. So one of the interesting changes I noted this month is they've put the Sunshine Coast at the peak of the market for houses. It had previously been at approaching the peak of the market. So it's worth downloading their full report and reading it if you're interested. If you're a long-term holder of investment properties, this is never a reason to sell. If you're looking to ever sell a property that you've got, it's always nice to time it closer to the peak than the bottom, but it also depends what you're doing with that money, and that's a discussion we need to have where you've got property. They've still got Sydney, Melbourne falling. They haven't got them approaching the bottom yet. And then you'll see the markets they believe are at the bottom, the most notable one, Perth and Darwin. But also for us in Southeast Queensland, Toowoomba. Now, the most interesting thing for our younger clients and those that are looking for investment properties, our probably most preferred spot at the moment is in Brisbane, where we've seen the market soak up the excess supply, particularly in the unit market that was there for a few years. So Brisbane looks quite good on fundamentals, so not a bad spot to be investing for those where investment property is appropriate. Much the same story with the units, and as always, the transcripts of these slides will have a copy of the slides built in, but you can download this report from our friends at Herron Todd White. Just Google Herron Todd White property report, and they also have a long archive for those that want to go back and read what they were saying 2 years ago, 5 years ago, 10 years ago. This isn't designed, like all economic things, to be perfectly predictive, because nothing can be, and there's lots of markets within markets as well. The Sunshine Coast is interesting. They do note excuse me, that properties under 800,000 on the Sunshine Coast is still doing very well, particularly along the coast strip. So that is close to beaches, etc. So they do note that there's markets within markets. So as always, care required. So let's put that into perspective. What does it mean? So effectively that means steady as she goes. We're not seeing markets in extremely expensive or FOMO conditions, so that means keep it steady, stick with the plan. It's a reasonable time to be buying or selling. As markets get a bit expensive, it's not a bad time to take a few profits and rebalance if that's appropriate for where your plans are up to. If you've got new money going in the market, we may spread that out a little. And particularly if it does go up more, we'll average that in or wait till the market dips to get some of that money in. So, and it's, as I said, it's always a good time to rebalance if you need to top up the reserves or other withdrawals. Continue to review as always. That's what our face-to-face reviews do. And if you've got changing circumstances, as always, yell out. We can always chat between reviews. So I want to reinforce the process. Goals first. The goals for your plans should always be based on who and what's important to you. That is your life, and I've changed the title of this slide to Exciting Life and Boring Money, and hopefully that's your goal. And the idea of this little snippet that we do once a month is not to make your money any more exciting, but to give you assurances that we take all the stuff that's going on seriously, although most of the time it leads to not much to do. Portfolios are designed to meet your goals. We do take a long-term view, and that means all the boring stuff, diversification, asset allocation, and liquidity that's appropriate to get you through the cycles. Low cost index for most growth markets, and that's proven to be a really good result for us, with all of our portfolios outperforming active managers, partly because of fees, but partly because of less activity. In the short term, we protect against market volatility, one through awareness, excuse me, and the other through the reserves that we hold for our retirees, and by averaging in for our accumulators, and rebalancing regularly, a boring but a good one. That's it for this month's On Track. Looking forward to talking to you next month. I will be doing that just after a trip I've got coming up. We've got the GPS conference where I'll be presenting to GPS advisors on a variety of subjects, and then having a brief family holiday in New Zealand, back in about the middle of July, right in time for the next On Track. If I don't talk to you beforehand, I'll talk soon.